What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday, everybody. Hope you're having a good start to the week. Manufacturing. It is a critical aspect of the Chinese economy. The industry accounted for 27% of China's GDP last year, and unlike property development or infrastructure spending, the manufacturing sector largely contributes to healthy, more sustainable growth for the country. And for comparison, manufacturing is about 25% of the South Korean economy, 20% of the Japanese economy, 18% of the German economy, and 10% of the US economy. Recently, however, Minister of Commerce Wang Wentao at a press conference discussed new data for foreign investment in China's manufacturing sector in 2021, and the data was not particularly positive. The official data indicates that realized foreign direct investment, FDI, in manufacturing fell 4.6% in 2021 from 2019. Manufacturing foreign direct investment accounted for 19.4% of China's total inward foreign direct investment last year, down from 20.8% in 2020 and 25% in 2019. This all shows that FDI, foreign direct investment, in the sector has not returned to pre-pandemic levels. There is some argument among Chinese economists as to what specifically is driving this downward trend, with a common explanation touching on the impact of Beijing's zero-COVID policy, more on this shortly, and the continued fallout from the Trump-era US-China trade war, or tariff war as some call it. Zhang Zhiwei, chief economist at Pinpoint Asset Management Limited, speaking to domestic financial media, for example, expressed that the trend of multinationals relocating their supply chains from China to cheaper countries may have been compounded by China's zero-tolerance COVID-19 policy that makes it hard for their employees to travel to China. We remember last year, of course, survey data published by the British Chamber of Commerce in China showed that hiring and retaining foreign employees was the most pressing issue for corporate UK. Surveys of German and US companies operating in the mainland indicated similar frustrations. There is also the argument that international investor confidence in the PRC generally has been hurt over the last few years due to Beijing policy moves, both economic and political. There is also the general trend that we have seen since the beginning of the pandemic of the US, Japan, and some European countries seeking to restructure their international supply chains and withdraw some production from China due to concern over-reliance on the People's Republic of China for critical manufacturing. Some have called this process decoupling. For example, in 2020, we covered Japan's plan to spend $2.3 billion to reform supply chains, including subsidies for Japanese companies that would bring manufacturing back to Japan. In this plan, China specifically was mentioned, as was the concern over-reliance on the geopolitical competitor. However, the main driving factor behind the shrinking manufacturing investment may indeed be the same factor behind similar trends that we have seen across many other economies around the world in recent decades. Costs, especially labor costs, are getting too expensive in China. Whatever the reasons, manufacturing foreign direct investment is shrinking, as is manufacturing as a percentage of the economy. This isn't a collapse like some claim, but it is a moderate change. During the press conference, the Commerce Minister expressed concern with the trend and committed to pursue policies to reverse it. Quote, "Our next step will be to strengthen support for the manufacturing sector to attract foreign investment. We'll guide more foreign investment into fields including advanced manufacturing, strategic emerging industries, the digital economy, and green development." End quote. In yesterday's video, we discussed the situation in China's business and financial capital, Shanghai. I said in that video yesterday that despite surging case numbers and pressure from Beijing, Shanghai authorities have pushed back against a full city lockdown, the sort of lockdown that we've seen in other areas across the country, due primarily to concerns around the massive economic costs and disruptions that shutting down the economic megacity would cause. As late as Saturday afternoon, Shanghai officials were claiming that Shanghai should not be locked down and would not be locked down. Then, in a sudden policy shift last night, Sunday evening, Shanghai officials announced that from 5 a.m. the following morning, today, Monday morning, the Pudong New Area would lock down for 4 days of mass testing. The Pudong New Area is an expansive territory east of the Huangpu River, which cuts through the megacity and is home to about 5.7 million people. Other districts will lock down too, and as of the filming of this, have locked down too. This coming Friday, Puxi, on the western bank of the river, Shanghai proper, and the traditional site for Shanghai, will go into lockdown for 3 days too. Residents will be barred from leaving their homes, while public transport and car hailing services will be suspended. Private cars will not be allowed on the roads unless necessary. This is very much a policy U-turn for Shanghai. Last week, local authorities repeatedly denied that Shanghai would be locked down. The economic cost of this policy shift will likely be high too. Quote, "The orders are set to disrupt operations at key facilities, from the Yangshan container port and Pudong International Airport to Tesla's Gigafactory and production centers owned by SMIC, China's biggest chip maker. The local authorities did not say whether the Pudong Airport and Yangshan Port would be shut for the lockdowns." End quote. However, today, the state-run Securities Times reported that the port, the biggest in the world, will maintain operations during the lockdown. We also learned this afternoon, too, that cargo terminals at Pudong International Airport will, in fact, operate, but under closed-loop management and with a skeleton crew. Concerns still remain, though, for China's semiconductor manufacturing and packaging value chain, which relies heavily on Shanghai. This morning, the central government confirmed over 6,000 new officially recognized cases from yesterday, the highest number since the original outbreak in Wuhan. We will continue to follow outbreaks and lockdowns in China as they develop this week. And last up, the Evergrande Housing Crisis. If you're enjoying the content or you're getting some value from the content, guys, don't forget to hit the like button. It's a huge help for a small channel like this. I really appreciate the support. If you're watching for the first time and you're getting some value from the episode, maybe consider subscribing. We release one of these every day. And if you want to be on top of the latest developments, hit that bell notification. Okay, analysts with UK-based Japanese-owned Financial Times reported today that Chinese property developers' issuance of dollar debt has, quote, come to a near standstill, end quote, as the escalating Evergrande crisis severs other real estate companies' access to global capital markets. Quote, high-yield dollar bond issuance by Chinese developers during the year to date is down a record 97%. Compared to the first quarter of 2021. So far, just 2 deals worth less than $295 million in total have gone through, compared with the more than $8.7 billion in the first 3 months of last year, raised across 30 deals. End quote. The report shows that the cost to borrow on international markets has reached new highs for Chinese developers too. According to a Bank of America index tracking Chinese high-yield bonds, the average yield on those instruments hit 32.9% in March, passing the previous high of almost 32% in 2008. During the worst days of the global financial crisis. This dual hit highlights how the crisis with Evergrande is bleeding more widely across the market and may make it too expensive for companies in the sector to either raise new debt or refinance existing borrowing, increasing systemic financial risk. Existing international investor concerns have been exacerbated in recent days too, after 6 Chinese property giants, including Evergrande, Shimao Group and Kaisa Group and others, said that they would miss a deadline to file audited annual results in Hong Kong this month. We covered this in detail last week. We also explored last week the trend of the growing price disparities between domestic bonds and international bond prices by the same developer, indicating different degrees of market confidence in financial instruments being repaid domestically versus overseas. But with Evergrande bonds maturing in 2025 trading at just 13 cents on the dollar, the market isn't impressed, and not just when it comes to Evergrande. One Hong Kong-based fund manager speaking to the Financial Times said that both international and Chinese investors have been selling off developers' bonds regardless of whether the issuers faced immediate repayment issues or not, expressing, quote, "They're dumping almost everything. Good names, bad names. If people want out, they'll dump the good names because they have trading liquidity. There's a lot of cynicism now on believing anything developers say." End quote. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.